I put this narrative and data together in the last week, and here this week we see the markets are already fulfilling on the knowledge that I'm going to share, but it's still important to know this anyway. So we know there's been a big fall here recently. In fact, I call it the fall of 2011. Roughly a 16% sell-off in the S&P 500 in a 3-week period. Also in one day, which was August 8th, there was a 6.7% fall in the S&P 500, which is pretty unprecedented. But it made me go back in time and reflect. 1987, Black Monday, we had somewhere around a 20% fall in one day. But if you stuck with your strategy, you can see that within 1 year, you're up 25%. In 5 years annualized, you're up 13%. And 10 years later, you're up 15% rate of return annualized. Back in 1962, we had a 7% sell-off in one day. Again, if you stayed in for the additional year, you're up 25%. Over a 5-year period, somewhere around 10%. And then on a 10-year period, you're up roughly 7% annualized per year. More recently, 2008, this is October, right in the middle of the financial crisis and debacle there, we had a 9% sell-off in one day, but notice that within 1 year, we saw a 21% rebound. On average, if you look at the worst 15 days in the S&P 500 since 1950, the average fall in those worst 1 days has been roughly an 8% downswing. But notice that if you stick with your strategy, within 1 year on average you're up 21%, on 5 years you're up roughly 8%, and on a 10-year the average is somewhere around 10%. What does that mean to you? That means on $1 million invested within 1 year it's at $1.2 million. On 5 years, 8% annualized, it means it grows to roughly $1.5 million. And in 10 years at 10%, it grows to almost $2.6 million. Meaning, downfall in the market, a rough day. If you got out, you missed this upside. And this is just part of the story. If you had the strategic knowledge to be allocated globally, like our clients are, the story's even better. Which brings me to today. Katie and I were shocked at this last night when we made this realization. We were talking about it at dinner right next to William. Right now, the yield on the 10-year Treasury bond is 2.1%, meaning people are lending money to the government with a promise of 2.1% return, and then they get their principal back in 10 years. At the same exact time, the S&P 500, the current dividend yield is 2.12% or higher than the 10-year Treasury bond. Imagine getting the same cash flow. Which of these two, a Treasury bond, which you know you just get your principal back, versus owning 500 of the great companies of America and the world, which one's going to produce more return for you in 10 years? Food for thought. Know your strategy. Stick with your prudent investing principles. We know they always win in the end.